In today's episode, we'll break down two important stories. First, we'll talk about why a gas cylinder stock exploded, and then we'll talk about whether India's smallest businesses are getting loans. Welcome back to the Daily Brief by Zerodha, where we cut through the noise to help you understand what's actually happening in the most important stories from business and markets. I'm your host Akshara, and today is Friday, 3rd July. Coming to the first story. So on paper, Maurya Udyog Limited makes steel gas cylinders. Back in 2017, its shares traded at roughly 10 rupees a piece. There was little reason for it to go any higher. This was a small listed company with no obvious growth story behind it. But slowly, it started climbing. Not dramatically, but steadily and without any obvious explanation. The company hadn't announced any new factories, it saw no sudden earnings jump, and there were no corporate announcements that would justify a re-rating. Nothing in the underlying business seemed to explain what the share price was doing. Yet it kept rising past 50, past 100, past 200 until it touched rupees 255. Account for a 1:10 stock split while reading the prices here. Now, at that point, the stock got a lot of attention from major brokers, or at least so it seemed, because traders began getting messages recommending that they buy the stock from what on the surface looked like ICICI Securities or even your own friendly neighborhood brokerage, Zerodha. At the same time, websites with names like midcapgains.in and mbstocks.in pushed the same stock. And the public rushed in. In just a few days, trading volumes for the stock on BSE jumped more than 16-fold. In fact, this was the story of many different stocks. Vishal Fabrics, 7NR Retail, GBL Industries, Darjeeling Ropeway Company, all of them saw the same pattern. Something smelled off, and it seemed suspicious enough that SEBI began looking in. So when the regulator finally came out with its order on June 30th, it described having uncovered a scheme on almost industrial scale. Now, the most obviously suspicious link in this chain were the messages. It was clear that these were spoofed and brokers didn't actually send them. But who did? So there are companies that help you carry out bulk messaging campaigns called SMS resellers. These companies buy wholesale SMS credits and give these out to anyone that wants to run a messaging campaign. Whoever was sending these messages had used the services of these companies. Now, the resellers had never met the person that had placed these orders. Everything had come to them online. But the orders had a digital trail. WhatsApp messages, emails, online payments, all of them pointed back to one person. Hanif Sheikh. Only Hanif denied everything, and those numbers didn't belong to him, he claimed. At one point, he attributed everything to an entity called Darshan Orna, and later his explanation shifted to a staff member named Inayat Deria. But the more SEBI looked, the more suspicious he looked. They saw KYC filings, Yahoo account recovery emails, IMEI device identifiers, and cell tower data. Everything came back to him. He made flight bookings from that phone, he had a Swiggy account linked to the phone, and the same device was used to book a Zomato order to a hotel where he was staying at the time. There was simply too much linking Hanif to those messages. But bulk SMSes were only the tip of the iceberg. So by itself, a bulk SMS recommending some obscure micro cap would perhaps have done very little. Those messages had built themselves atop a base, and these weren't dead stocks. They were stocks that had seen a meteoric rise over the better part of a year. And those messages worked because they seemed to confirm a story of a stock that, in the case of Maurya Udyog, had shot up 25 times in a few months. So why did the stock move in the first place? Now, there was something fishy in the lead up to these SMS campaigns. In the case of Maurya Udyog, for instance, 11 entities had been trading its price up for a long time. They would place orders within seconds of each other, often in tiny quantities, at prices just above the stock's last traded price. The resulting movement looked organic, and the stock, to naked eyes, would appear to be on an uptrend. But was there any fraud here? SEBI had run into this wall before. In many cases before this, people had made synchronized trades, often sending up the price of a stock. But to courts and tribunals that heard them, though, this was hardly enough evidence. Buying a stock wasn't fraud, selling one wasn't fraud. So, if SEBI claimed that such a series of transactions somehow amounted to fraud collectively because of how they were timed or because of what their effect was, it needed to prove it. So, for this, SEBI pointed to a few things. One, those 11 entities seemed suspiciously close to each other. They shared the same addresses, phone numbers, and bank accounts, and money seemed to move between them. Moreover, Maurya Udyog wasn't a stock that saw a lot of activity. Over its incredible rise, these 11 entities contributed 40% of all buy volume and 35% of all sell volume. So, if you strip just these 11 entities out, the stock's trading volumes would crater. That was why this seemed suspicious. Why were 11 entities that all seemed linked trading in a stock that barely anyone else cared for? Why did their trades keep marking the stock's price up? To SEBI, it was more likely than not that there was fraud underneath. Now, when the SMS campaigns began, a new group joined the fray. They made many small and buy sell orders on the same day, consistently losing money, and together they lost roughly rupees 37 lakh. Their trading didn't make a lot of sense, but they made up almost a quarter of the trading activity in Maurya Udyog for as long as the campaign ran. So, why would anyone do this? There was one clue. It seemed like they were paid for it. One of these traders, for instance, had received rupees 23 lakh from a connected company called GBFL. The very next day, he transferred that money to his broker and began trading in Maurya Udyog shares. Now, to SEBI, their trading seemed like the cost of pulling such a scheme off. So once traders poured in after the SMS campaigns, the stock would have to look liquid. And these entities did exactly that, creating the appearance of active trading. It didn't matter if they were profitable. Their job was to make it seem like there was a lot of action in the stock. But if this was actually fraud, how did it pay off? Now, all of this was meant to create a group of buyers interested in Maurya Udyog shares. And then came the dump. So, a new group of entities, Maurya Udyog's promoters, employees, and contractors, stepped into the market to sell their shares. Many of them had not traded in it before the SMS campaign and wouldn't trade after it. They had gathered their shares before the stock's listing or through off market transfers, and they sold them at the peak of its SMS driven frenzy. But the money didn't stay in their accounts. Instead, it was all drained out instantly to one of two entities, Linkwise and VM. Curiously, these two entities had odd connections to Maurya. Both their email accounts, for instance, had the same recovery email, imgupta@maurya.com. Maurya officials signed on their rent agreements, and Maurya even listed them as its related parties in its financials. And most tellingly, Linkwise and VM sent money back to Maurya, and they both had their excuses. Linkwise, for instance, claimed that it sold Maurya cattle feed and soya cakes. It even had GST certificates for these sales. Only, why would a company that made gas cylinders buy cattle feed? Plausibly because cattle feed doesn't attract GST, so they could get certificates without actually paying any tax. Beyond that, they couldn't produce a single invoice or e-way bill. VM had a similar story of its own, but that too was full of holes. But Maurya Udyog's promoters weren't the only ones that benefited from this. There was another network that had offloaded shares in the SMS-fueled frenzy. And the money then traveled through a series of accounts for transactions that seemed unremarkable. Business payments, loan repayments, and the like. It was hard to see exactly where each payment went rupee for rupee, but at the end, much of that money seemed to land in accounts controlled by Hanif. So proving anything here was a challenge. SEBI couldn't map every single payment from start to finish. It had been recycled too many times. But to SEBI, this wasn't necessary. It could clearly see the net effect. Money went via a series of accounts to a series of beneficiaries. How it got there was irrelevant. Ultimately, it was more likely than not that this was a way to push out the proceeds of the fraud. Now, this didn't happen once. Variations of the same playbook were visible across 5 different companies, and there were minor variations across them, like different promoters and different excuses. In one case, for instance, everyone pinned the blame on a mysterious figure named Paresh Shah, even though they couldn't provide a phone number, an address, or any verifiable trace of this person. In another, BSE's surveillance system killed the fraud before it could go through, forcing the operators to exit as a loss. Ultimately, though, they all shared the same pattern. The same artificial price movement, the same SMS campaign, the same sudden jumps in trading volume. And at the heart of all of them was Hanif Sheikh. In all, SEBI investigated 226 different people and entities. There were three it didn't find any evidence against, and two that were only guilty of dumping their shares and not outright fraud. Everyone else, though, was part of this massive scam network. It found nearly rupees 140 crore in illegal gains, which it asked these entities to disgorge along with 12% interest. Beyond that, it handed out penalties and securities market bans to everyone involved. Hanif himself has been barred from the securities market for 7 years and fined 10 crore rupees. His broader network saw bans of 4 to 5 years and fines ranging from rupees 5 lakh to rupees 1 crore. The stock market is replete with stories that look too good to be true. Often, that's because they aren't true. Many of these scams look obvious from the sidelines in hindsight, but there's no guarantee that you'll see one that's being played on you. As this case shows you, many of these scams are designed meticulously over years with explanations for anything that looks off. At many points, SEBI itself couldn't prove that something was wrong, instead falling back on what seemed likely to it, and that was after years of investigation. You might not have that benefit. Now, we can't speak for other brokers, but if you ever hear Zerodha asking you to invest in some stock, you can be certain that someone's trying to dupe you. For all the sources mentioned in this video, don't forget to check out our newsletter. The link is in the description. Coming to the second story. In 2020, two economists at the National Institute of Public Finance and Policy, or NIPFP, took a giant government dataset on India's smallest businesses and asked a simple question. Which of them get a loan from a banker rather than a money lender? 5 years later, the same two economists, Shivani Badola and Sachidananda Mukherjee, took a newer version of the same dataset and asked a sharper question. Which of them are actually starved of credit? The distance between those two questions helps us gauge where it is that India's entire small business finance infrastructure is stuck. Now, the firms in question are unincorporated enterprises like the corner kirana, the roadside welding workshop, the single truck operator, the two-person tailoring unit, companies that aren't registered under India's Companies Act. And there are an estimated 6.5 crore of them employing around 11 crore people, the ground floor of the Indian economy running on a chronic shortage of money. And that's a huge shortage. So the International Finance Corporation pegged the addressable credit gap for Indian MSMEs at roughly rupees 25.8 lakh crore. And formal lenders do not serve this demand. That's the backdrop against which these two papers are worth reading together. So the 2020 paper sorted enterprises into a clean binary. You either had an outstanding loan from a formal source like a bank, or you had one from an informal source, meaning a money lender, a supplier, a relative. Formal was the good outcome and informal the bad one. And the exercise was to figure out what pushed a firm from one column to the other. This framing also carried a hidden assumption that a formal loan meant the problem was solved. But the 2026 paper is built to break that assumption. So instead of formal versus informal, it sorts firms into three buckets: fully credit constrained, partially constrained, and not constrained. So this implies that a firm can now show up as holding a formal loan and still be counted as constrained because the loan was too small, too costly, or came nowhere near what the business actually needed to grow. On the newer measure, only 35% of these enterprises are not credit constrained at all. Roughly 36% are fully constrained and another 29% partially so. Essentially, nearly 2/3 of India's smallest businesses are unfortunately running on less credit than they could productively use. Now, one caveat worth mentioning is that the 2020 paper used the old NSSO Enterprise Survey and the 2026 paper uses its replacement, the Annual Survey of Unincorporated Sector Enterprises of 2022-23. Now, these two aren't perfectly comparable, so some of the differences between the papers may reflect the change in the ruler, but not in the thing being measured. Let's start with a headline finding that's universal regardless of the ruler change. Size predicts credit. Bigger turnover, more assets, more workers, a longer operating history. Every one of these factors makes a lender more comfortable. Firms that have them borrow formally far more easily than firms that don't. And the 2026 paper only sharpens this truth. Size makes you more likely to get a loan and less likely to be constrained. And the relationship between size and credit isn't linear. It curves, with the biggest reduction in constraint coming as very small firms grow into merely small ones and then flattening out. The handicap is worst precisely at the bottom. So, why does smallness bite so hard? It's not because tiny firms are bad bets, but because they're illegible ones. So, a lender looking at a two-person workshop with no filed accounts and no paper trail doesn't get a lot of trust. Which brings us to the most interesting shift in the paper. See, for most of the history of Indian lending, creditworthiness meant the assets you could pledge, like land, machinery, and gold. If you couldn't put something on the table, the bank could seize. You didn't get the loan, or at least found it hard to get one. That world still exists, and there's another logic that's rising, where creditworthiness is built less from what you can pledge and more from what you can prove with information. So, in the 2020 paper, all systems of record from GST registration, business registration, books of account to internet use raised the odds of formal borrowing. But in 2026, each one lowered the odds of being constrained in rough times. None of them is collateral, but all of them are data that allows a lender a more transparent look at an otherwise opaque little firm. Now, the single strongest signal of the lot, swamping every other variable in both papers, is whether the firm has a bank account. So, a bank account isn't merely money, but also a stream of transactions a lender can read. Across 2 decades of Indian research, the manufacturing sector keeps showing up as the neglected child of formal finance. That hasn't changed in 2026, as the new paper identifies manufacturing as the single most credit constrained category of business in the country. More than half of manufacturing units are fully constrained against roughly a quarter of service firms. Now, as per the paper, a manufacturer comes out about 8% likelier to be fully credit constrained than an otherwise identical services firm. The raw borrowing patterns say the same thing. Of the manufacturers who borrow at all, over half go to informal lenders against about 25% of service firms. And where formal money actually lands, manufacturing holds a low share of approximately 15% of all outstanding loans to these enterprises, while services take more than half. Partly, this also reflects India's heavy tilt towards services compared to manufacturing. Now, manufacturing is, on the face of it, the sector you'd expect banks to like. It's where the fixed, sizable assets sit, the machinery and sheds that can be easily used as collateral. So, why is the asset heavy sector the hungriest? The papers are far more confident about the observation than the reasons behind it. So, this is worth holding loosely. But they may include reasons we've discussed before on the daily brief. For instance, manufacturing may simply read as riskier to a lender because it can often be starved of working capital, or it often runs on tight margins which only come with scale. And as per the 2020 paper, heavier exposure to operational shocks like power cuts, input shortages, sudden dips in demand pulled credit access down. And the reasons could be varied. But either way, manufacturing is the sector the country is trying hardest to expand, but also, sadly, the one our credit system serves worst. Now, the 2020 paper also found something very interesting on gender lines. Women owned enterprises were more likely than men's to hold a formal loan. The authors credited the wave of targeted schemes like Mudra, Stand Up India, dedicated women's credit lines, which were meant purely to push formal money toward women entrepreneurs. But the 2026 paper somehow finds the mirror image. Female proprietors are more likely to be credit constrained, not less, around 4% more likely to be fully constrained than comparable male owned firms. So, which is it? Do the schemes work or don't they? The resolution isn't that the world reversed itself between 2016 and 2023. It's that the two papers are measuring different things. Did she get a formal loan? And did she get enough credit? Are separate questions. A woman entrepreneur can clear the first part and still fail the second because the loan is smaller, dearer, and further short of what the business needs than a comparable man's would be. Now, the wider evidence only further spotlights the disadvantages female entrepreneurs face. An independent study using the very same 2022-23 dataset found women-owned firms less likely to get formal credit, and when they did, they received smaller amounts. So SIDB put the credit gap for women-owned MSMEs at around 35% against roughly 20% for men. So, the 2020 report finding, read next to all this, looks less like a triumph and more like a measurement catching only the easy half of the problem. Now, the 2026 paper opens up two further seams the earlier one didn't touch. The first is caste. The newer data lets the authors ask whether owners from scheduled castes, scheduled tribes, and other backward classes face steeper constraints. And it finds that they're significantly more likely to be fully or partially constrained than upper caste owners. So, one intuitive reason for this could be the historic lack of wealth that puts marginalized castes a lap behind. They tend to hold fewer assets and less land than they can pledge as collateral, and long exclusion from the relationships and references that formal lending ran on doesn't help. Which is why these borrowers have historically leaned so hard on money lenders in the first place. The second theme is geography. You would expect urban firms packed around bank branches to be the better served ones. Instead, rural enterprises come out less constrained. Roughly 75% of the loan value rural firms carry comes from formal lenders against about 66% in the cities. But this difference may be explained by the same phenomenon that determined access for female entrepreneurs. While more of them got credit, it was hardly enough. See, India spent decades building priority sector lending rules that compel banks to direct a slice of their lending to agriculture and small rural enterprise, regional rural banks, cooperative societies, and the vast self-help group and microfinance networks that, in this data, count as formal credit. The urban microfirm never got a delivery system built with the same intent, but rural units skew heavily toward the tiniest own account kind, the very category the same paper shows is most constrained of all. So the rural advantage is real, but it's swimming against the current of what rural firms mostly look like, which arguably makes the reach of that inclusion machinery more impressive, not less. So, the most useful thing these two papers do, read side by side, is mark a change in what we think the problem is. For 20 years, the question was whether India's smallest firms could get through the door of the formal financial system. And that door has genuinely opened wider. On the old measure, that's progress. But on the new one, it barely makes a dent. Now, coming to the tidbits. Russia has started importing petrol from India by sea after Ukrainian drone strikes destroyed nearly 25 to 30% of its refining capacity. At least 60,000 tons have already been dispatched, with plans to import up to 400,000 tons a month. Coming to the next tidbit. ITC is entering the cola business for the first time, wanting to compete with Coca-Cola, PepsiCo, and Reliance's Campa in India's growing soft drink space. Coming to the final tidbit. Adani Group and Abu Dhabi's IHC have signed an MOU to build a massive aluminium plant in Odisha with an $11.5 billion investment. The plant could increase India's total aluminium capacity by nearly 50%. That's all the news I have for you. Thank you so much for watching and see you in the next one. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.